Imagine you are a regular investor. You open a company's financial report and see a clean audit opinion. The report says the company presents fairly. You relax. You think, if the accountants signed it, the story must be fair. But then imagine one important fact is buried or left out. The company lent a lot of money to another company that may not be able to pay it back. Technically, the report may fit the rules. The boxes may be checked, but the picture you receive is misleading. So here is the hook. Can a company follow the accounting rules and still give people an unfair account? Yuji Ijiri, a legendary accounting theorist at Carnegie Mellon, thought this question was at the heart of accounting. To him, accounting was not just a machine that turns numbers into information, it was a moral relationship. He pictured three characters. The accountor gives an account, the accountee depends on that account, and the accountant stands between them. The accountant's job is not only to move information, the job is to protect a fair flow of information. That was Ijiri's big question. What is the ultimate basis by which an accountant can judge what is fair? The first idea is simple. Rules matter, but rules are not always enough. Think of a traffic light. If the light is green but a child is crossing the road, you do not say, "The rule says go, so I'm going." You understand that rules serve a deeper purpose. Accounting rules are similar. GAAP matters, standards matter, evidence matters, but the paper says fairness cannot be reduced to checking a rule book. Now we need a test. The paper uses a moral idea called the generalization test. Here is the easy version. Before acting, ask, what if everyone in the same situation acted for the same reason? Suppose I lie whenever lying helps me. If everyone did that, trust would collapse. My own reason for lying would stop working. So the reason defeats itself. Now imagine an auditor saying, I will approve this questionable report because it helps my client, helps my firm, and technically fits the rules. What if every auditor used that same reason? If every audit stamp worked that way, the audit stamp would lose its meaning. People could no longer trust it as a sign of fairness. So the action fails the test. That sounds simple, but the paper makes the story harder with the game theory. Here is the everyday example. Resume padding. If nobody exaggerates, adding a little shine gives you an advantage. But if everyone knows resumes are padded, employers discount the claims. A fancy job title gets mentally marked down. That is signal jamming. The signal is the report, resume, or accounting number. The jamming is the bias added to make the sender look better. If everyone expects the bias perfectly, the receiver adjusts. So is the bias still unfair? The paper's answer is careful. Sometimes it may be, but only under strict conditions. If everyone truly knows the exact amount of exaggeration and everyone adjusts in the same fair way, the practice may not mislead. But real life is usually messier. People often know only that some exaggeration happens. They do not know how much. They do not know which trick is being used. In that case, saying everyone does it is not a moral excuse. Then the paper adds one more layer, the combinatorial version. Do not think only about how much exaggeration there is. Think about which kinds of tricks are used. On a resume, the bundle might include inflated responsibility, vague awards, selective dates, or unverifiable claims. In accounting, the bundle might include different GAAP compliant ways of making a company look healthier. The paper represents this like a set. B equals B1, B2, B3. In plain English, B is the bag of tricks. If everyone knows the exact bag of tricks, maybe people can adjust. But if people only know there is probably some trick somewhere, they cannot fairly adjust. The reason for using that specific bag is not coherent. That is why the paper matters now. We live in a world of financial reports, ESG scores, rankings, dashboards, credit scores, algorithms, and AI summaries. Information surrounds us, but fair information flow is not automatic. A number can be technically correct and still mislead. A disclosure can be legal and still hide the point. A ranking can be useful and still be unfair to people who depend on it. Ijiri's question is not old-fashioned, it is urgent in an information economy. Who protects fairness in the flow of information? Can accounting be not only a science of measurement, but also a discipline of accountability? And when experts say everyone knows how the game works, we should ask, does everyone really know? What do you think? If the rules are followed but people still walk away with the wrong picture, what should fairness require?